Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Fine, wonderful Friday morning in California.
Great. And I know that you're such a big fan. I've made sure the palm trees are back.
Yes, I sway to the rhythm of those palm trees.
Exactly. We need some, I guess, like soft reggae music or something in the background. But
I think.
a- as we always like to do, let's dive into a little reflection and market movements over the past week and Fed speeches, data, etc. Yeah, what's your strongest views and takeaways?
I think we might well be at an inflation point on inflation for a few reasons. First of all, the disinflation was really, my view has always been the disinflation has been driven by energy prices. And now they are getting to the point where year on year, they are kind of getting positive. I mean, almost there. Then there were a couple of interesting results out of the small business surveys. A continued increase in the number of firms that are planning to increase prices, a big jump in the number of firms that are planning to increase wages. Historically, these series are correlated with actual inflation and actual wages. PPI a bit on the high side. So, and of course, core inflation was higher month on month than expected, and also increased. So early days, and I am totally open to being wrong on my views, but I kind of see little sign here and there that we may be reaching the end of the disinflation, of the core disinflation. In terms of market definitely do not agree with me, do not believe the Fed. So Mr. Market is doing what Mr. Market does, which is, um, following on its strong opinions.
Right. Meaning like 4+ cuts are still priced in.
4+ cuts are still priced in, only half a chance of one more cut this year.
One more hike.
So,
Yeah.
yeah,
Okay.
yeah, which if you believe what break-even are telling you, which is that inflation is going to go back to 2% very soon, makes sense.
Right. Right. Okay. Anything else? Any other speeches? Anything
So this
political
was
wise? Yeah. Catching your
the
eye the past week?
lots, but no immediate market impact. So impeachment proceeding against President Biden got started. I mean, if this has the impact on markets, would be only long term. If this and other factors lead to President Biden actually not running next year, and a centrist younger candidate becomes a front runner, that could have some market impact on the Fed, for instance. So that's one. The other one is Republicans putting in place some strategy to fund the government after September 30th, which is the expiry of the fiscal year. And not our first rodeo. I mean, each time we get into this brinkmanship, it gets resolved last minute. So call me, I don't know, cynical, blasé. I suspect we'll get it resolved probably at midnight or maybe 1 o'clock in the morning on October 1st. The bottom line is that historically, when the Republicans have shut down the government, it has hurt their electoral prospect. So, and the other element, event, the start of an auto strike with a union that is much more aggressive and smarter, I think, than in the past, because they are going to make it a rolling strike and target, key points in the supply chain, which means that their members will suffer from less of an income loss than if the strike had been indefinite and indiscriminate. And so strike is much more sustainable. Again, a sign that the labor market is very tight. My problem with this view is that I can see signs of labor market tightness everywhere except in the wage data, which is still growing as a snail pace, which could simply reflect lag. So we'll see. I was also surprised by this morning a consumer confidence survey from the University of Michigan. Inflation expectation fell when prices of gas went up. So this could just be a bad data. So we need to be patient on wages, on inflation expectation. Probably the interesting changes are still in front of us.
Okay, that's great. Anything else? Anything on like the student loan payments coming back? Like some people are asking what kind of impact that's going to have on the market, or obviously even the deficit.
So for sure, it's negative, but is it going to break down growth? I mean, kill growth? I don't think so. One reason why the impact of student loan is getting a lot of airplay is that most of the people working in media, including in financial media, have student loans. But if you look at the American population in general, and there is, hard Fed data showing that only 1 in 6 American adults has a student loan. And then the administration is putting in place a new repayment plan, income-driven, that should cut the servicing in half. And those plans, for technical reasons, are less likely to be challenged in the Supreme Court than the cancellation plan. And finally, the default on those student loans has always been horrendous, about 10%. And I have a nagging suspicion that, the repayment culture has not improved with the moratorium, the 3-year moratorium we just got. So I have a suspicion that there will be, shall we say, a natural decline or spontaneous decline in repayments, with borrowers, taking their own sweet time to start paying. So, and this is an election year. College graduate academics are a key democratic constituency. I can't see the government being very aggressive in pursuing delinquents. So for sure, on the margin, it's negative. Is it going to kill growth? I don't think so.
Right. Okay, great. Okay, in the upcoming week, what are the key things clients should be looking at?
So the Fed, of course, and on the Fed, my expectation haven't changed. No hike. I agree with the market. I still think there will be a hike in 2023 because that is what was in the June SCP, and inflation is behaving according to the SCP. So I think we get same inflation, same Fed funds in the SCP for 2023. 2024 is where it gets interesting. I don't see the Fed changing its inflation forecast, certainly not raising its inflation forecast, because this would be the 4th year of inflation above 2%. The Fed doesn't want to give the impression that it's raising its actual targets through the back door. So it's going to stick with its 2.6% quarter Q4 and Q4 for core PC next year. But on the other hand, since growth is so much higher than the Fed expected, they have 1% Q4 and Q4 for this year. If you look at the Atlanta Fed, they have Q3 pegged at nearly 5%. New York Fed, yeah. The New York Fed above 2.25%, so above trend. So the FOMC will have to mark to market its growth forecast for this year, possibly next year. And as a consequence, I think they will cut the number of 2024 cuts because they believe, and Chair Powell said so at Jackson Hole, that higher growth is not good for disinflation in the longer run. So as a sort of insurance, they'll just cut down the cuts next year.
How do you think the market is going to take that?
I think the market is going to completely ignore it. Just like the market right now is pricing only half a chance of a hike, of one more hike this year. The market just doesn't believe that the current combination of growth and inflation is such that there is ground for the Fed to hike this year or to not cut 4 times next year. And so the changes in the Fed, in the market pricing are more likely to come through Fed comments than through the data.
Okay, great. And then on the data, what are the most important releases next week? And what else, I guess, could potentially be an outlier and have a market moving impact?
So most important will be, I think, the residential real estate data. We have the NAHB index, building permits, housing start, existing home sales. And I think it's all going to paint the same picture of a recovering residential market, as well as recovering residential investment. Can't see it moving the market in terms of Fed pricing either, because I see the potential for big surprises as quite small. Jobless claims, we're going to get something quite close to where we are now, which is consistent with a tight labor market. But again, the market participants don't believe that the tight labor market is a reason for not cutting next year. So I don't see, to be honest, I don't see any of the news having a lasting market impact. I think the Fed will be the main event. And as I said, I think Powell will struggle to convince the market that, he is really a tough guy.
He's been trying. He's definitely been trying the last year.
Can't be faulted for not trying, that for sure.
Okay, awesome. So I'll just highlight a few pieces for our professional clients. If they haven't seen Bilal's Macroscope, 5 things you didn't know about the U.S. economy. Obviously, this is like his kind of themes or things that people may be missing each week, and really makes you think. Definitely say that's great, great reading. Hedere Mustafa doing global rates weekly, certainly after ECB, and some of the recent data, I guess, across the globe, what our favorite trades are on the rate side. Mirza and Leon Ding co-wrote a piece, U.S.-China Divergence to Extend. So a lot of it, this is also leveraging a lot of the stuff we do from the quantitative side or data science side of the China Growth Tracker. We, relying on you and continued very strong, views of very strong growth in the U.S., but still do not see great long-term demand picking up in China, certainly for now, and not from what we've seen from the government's stimulus moves so far. We have our trade idea survey from our network. It was interesting having quite divergent views on the yen. Our view in general continues to be a strong dollar view, particularly versus European currencies, but we still do think we still think dollar yen does trend higher. And there are a bunch of cool things. And highlighting the China growth tracker. Caroline put a piece out on why she wants to be bearish Huff, and yeah, put out a lot of stuff this week. So hopefully, again, stuff on commodities, all our model based stuff, including the stuff on all the carry indices that we do and the work there. So hopefully everyone takes a chance to read through. We also been adding a lot of analytics, like charts, and we will be adding a lot more. So this is stuff on volatility and also inflation forecasting, and more stuff actually on central bank sentiment scoring. So just be on the lookout for all that in the coming weeks. And if anyone has any questions, feel free to reach out to myself or obviously Dominique or Bilal. And thank you, Dominique. It's kind of Friday afternoon. It's still actually pretty nice and sunny here in London, thankfully. And I'm wishing everyone a lovely weekend and very successful and enjoyable upcoming week. And yes, and for fellow viewers who are Jewish, Happy New Year, Happy Rosh Hashanah, and good luck. I don't know, any parting words?
Happy New Year to our Jewish listeners. And yeah, keep the feedback coming, negative feedback, especially welcome. And I'm working hard on those student loans.
Okay, cool. Awesome. Thank you. Bye.
Bye.